Welcome, everyone, and thank you for joining us today. My name is Tara McBride, Chief Marketing Officer at Prime Capital Financial. The latest tariff moves from the administration just hit the markets like a thunderclap. This morning, futures were down 3%, and as of this recording, it looks like Wall Street's in for a bit of a bumpy ride today. So before we get started, I'd like to share that we have a free resource available for you to download, so make sure you grab that as a supplement to this conversation. I'm once again joined by my three colleagues from the investment team at Prime Capital Financial and my personal Sherpas for all things markets, Clayton Allison, Portfolio Manager, Scott Duba, our Chief Investment Officer and President of Wealth Management, and Will McGough, our Deputy Chief Investment Officer. All right, let's get right to it. Scott Duba, what in the world is going on?
So, Tara, to put it simply, I think the market is trying to digest one of the most monumental global trade announcement in recent history. Yesterday, the Trump administration finally laid out their tariff plans in detail, and I think the market is trying to digest what ultimately ended up being a more aggressive package than what people are anticipating. So, a lot of countries impacted, a lot of sectors impacted, and a lot of big numbers that the market's trying to digest.
So, okay, Clayton, what exactly was announced?
Yeah, so like Scott kind of mentioned, the Trump administration came out and announced their new sweeping tariff policy, and what that kind of resulted in is a broad 10% minimum tariff on roughly over 60 different countries, and then targeted additional reciprocal tariffs on some key trading partners like China. They got an additional 34% tariff added on to their already pre-existing 33% tariff. So now they're looking at a 64% total tariff for all U.S. imports coming in, and that is obviously one of America's largest trading partners right now. So that's just on a more granular details, the kind of what happened yesterday and what was announced.
So why such a negative response to all of this, Clayton?
Well, it's partially what Scott mentioned earlier. They came out a lot more aggressive with their tariff policy than a lot of what the market anticipated. A lot were expecting, maybe some commensurate price increases, some tariff level increases, but the sweeping aggression that they took across all trade partners was kind of unprecedented. And now a lot of these U.S. companies have global supply chains that manufacture outside of U.S. borders, and they're going to see significant impacts from that as all of their imports are now going to get taxed at a much higher rate.
So, Will, talk to us about why the administration is doing this.
Thanks, Tara, and thanks everybody for joining in. So our view is that this shift is fundamentally about interest rates and a deliberate policy recalibration by the administration. If you look back the last couple of years, we had a couple things going on. Persistent deficits, which were fueled by government spending. Estimated 85% of job growth came from the public sector. Meanwhile, equity markets are extended in valuation, high price to earnings ratios with peak earnings growth. So what's going on right now is the previous administration issued a whole bunch of debt on the short end of the curve. That debt service is now having to come up over the next 12 to 18 months, about 7 trillion, 31% of our debt, which needs to be refinanced. So it's our opinion that the administration is using tariffs not only as a negotiating tool for their policies going forward, but as a way to manage sentiment in the short term to ultimately bring rates down, which will help lower the cost to the government when we have to roll this debt over the next 12 to 18 months.
So, Will, talk to us about how much pain the administration is willing to take on with all of this.
How much pain the administration takes versus how much pain our investors are experiencing, probably two different things. Nobody knows. Nobody's got the crystal ball with where markets are going to go. I like to draw analogies back to the early 80s when Reagan came in after Carter. What happened then was about an 18-month period where he was implementing his policies and a 35% drawdown in equity markets. We're only like 1 or 2 months in with Trump and down, in the mid-teens. So there could be some more pain to the downside. Markets are pricing that in as we speak today. How much lower it goes, nobody knows, but you don't want to bet against the American economy. It's not a straight line up, as Scott mentioned earlier, and that there are going to be pullbacks along the way, corrections and recessions and bear markets, which we hope to be able to take advantage of on your behalf.
All right, Scott, bring us home. What are the implications of all of this for clients?
Yeah, look, I think, like Will alluded to, this administration has some ambitious goals, but I would also add this administration is pretty sharp. It's populated with a lot of real business leaders, former executives. I mean, this is like a CEO type administration. And I'd say their strategic game is not about the S&P oscillating between 6,000 and 5,500. I think they're trying to game out how do we get the S&P not from 6,000 to 7,000, but to 10,000 to 15,000 over the next decades to come. Over the past few years, we've had a great market, but a lot of that's been funded by government excess, where I think this is a fundamental shift to a more solid domestic manufacturing-based economy in the U.S. And look, undoubtedly it's going to be bumpy. I mean, these are some transformational changes that the administration is pushing through. But, I mean, there's a lot of really good things happening below the surface with respect to government deficit spending, trying to manage the balance sheet that I think bode really well long-term for our investors.
Thank you, Scott. I mean, I think what I'm hearing is make sure you have a plan, talk to somebody about your plan. This is about a long-term strategy, not short-term action. So this is really just the tip of the iceberg. Ask yourself as an investor, are you ready for what's next? Scan the QR code to download your free companion resource, and make sure you're talking to your financial advisor about what all of this means for your own strategy. And if you don't have an advisor, our team is here and ready to help you navigate what's ahead. Thanks again to Clayton, Scott, and Will for their insights today, and to all of you for tuning in. And to our audience, stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market. Until next time.